Hello everyone, greetings from Ghana. My name is Jennifer Blagoji and I am the External Relations Manager for the UK-Ghana Chamber of Commerce. Promoting bilateral trade between the UK and Ghana is at the heart of everything we do at the Chamber. And so for that reason, we're excited to be hosting the second session of the UK West Africa Trade and Opportunity Summit. This session will focus primarily on financing options available for UK companies looking to do business in West Africa and for West African countries looking to do likewise in the UK. Now more than ever, these conversations are very much needed. Today's topic is very relevant to us given the magnitude of inquiries we receive on the subject matter and the business matchmaking services we make accessible to our member companies. Our panel of experts will walk us through their offerings and the trade and project financing options available for different projects in the UK and West Africa. We are truly grateful to our moderator, Steve Gray, the regional head of the UK Export Finance in West Africa and the Vice Board Chair of the UK-Ghana Chamber of Commerce. And of course, our panel of speakers today, we have Ms. Barbara Tetter, Mr. Andrew Wolfson, Mr. Musa Abdul Rahman, Mr. Gustavo Begamasco, Mr. Logie McKay, and Mr. Matthew Goddard. This series of webinars would not have been possible without our partners and sponsors, the UK Liberia Chamber of Commerce, the AM Group, the Bank of Africa Ghana, and Contractor Construction UK Limited. We're also grateful to Africa Alert for featuring this webinar on their websites. For companies looking to do business specifically in Ghana, we encourage you to reach out to us at the UK-Ghana Chamber of Commerce as we continue to create networks and connect businesses. And to everyone in our audience today, please follow us on social media. At this point, I would hand over to Steve Gray to take us through the rest of the session. Thank you very much, and we hope you enjoy this session. Thank you.
Jennifer, thank you very much, and good morning, everyone. Trade can be an important catalyst for economic growth and poverty reduction, even more so important with the ongoing impact of the global pandemic. However, Africa as a continent has yet to fully capture the growth-enhancing benefits of trade. Today, the continent's share of global GDP and trade stand at only 3%, and yet it accounts for 11% of the world's population. The infrastructure deficit that has for long inhibited regional and international trade is well known. Another major impediment, as highlighted in the most recent UK-Ghana Chamber of Commerce Business Climate Report, is the lack of availability of trade finance, the lubricant of trade without which opportunities for growth and development are missed. Whilst trade finance continues to be a relatively low-risk activity for commercial banks in Africa, the estimated default rate on trade finance transactions in 2011 to 14 was between 4 and 5%, compared to 9 to 12% in non-performing loan ratios for all other bank asset classes. However, West Africa ranks second worst behind Central Africa in terms of the default rates, with 7%, and SMEs averaging trade finance default rates at 14%, far higher than the overall trade finance default for the same period elsewhere. For Africa to improve its competitiveness, raise productivity, and achieve robust and inclusive growth, it is essential that African countries become more integrated into the global economy and have a strong and well-diversified export base. For this to happen, trade finance must genuinely be accessible and affordable to those who need it. Today, I am pleased to be joined by an amazing panel of speakers who will be discussing trade finance options for companies in West Africa and highlight some of the issues that companies need to be mindful of as they approach financing institutions for both trade and structured finance. But before we start the panel, may I invite the panelists to introduce themselves briefly, starting with Barbara.
Hello, everyone. My name is Barbara Tetter. I work with the International Finance Corporation as a senior investment officer. I work with the Financial Institutions Group, and I belong to the West and Central African team. I'm quite excited to be part of the panelists discussing all this important topic, and I look forward to the ensuing engagements. Thank you.
Thank you, Barbara. Moving on to Andrew.
Hi, I'm Andrew Wolfson. I am a partner at AF Capital Partners. We provide export credit-backed loans into, well, everywhere in the world that the export credit agencies are prepared to go. We have a very good relationship with UKEF, which is why I'm on the panel. We have completed recent transactions pan-Africa, but including in West Africa, including in Ghana. And very excited to talk about opportunities that may arise in supporting UK companies who want to export into the West African region.
Andrew, thank you. And to Musa, who represents one of our co-sponsors of today's event, Bank of Africa.
Okay, so Musa Abdurrahman is my name. I work for Bank of Africa, a member of the BMC group. We are a very strong bank with a strong footing in Africa and then the group as a whole. And that makes us a very strong bank to partner with when it comes to trade. This discussion today would offer us an opportunity to further let our participants know what Bank of Africa offers to its trade clients, and then also let our partners also know that when it comes to trade, we consider trade as a process and not as an event. So we walk you through from the commencement of your trade initiative till when you have achieved your goal. Thank you.
Thank you, Musa. And over to Matt.
Stephen, good morning all. Matt Goddard, I'm a director of Stronghold Global Finance in the UK, working in our London office. Stronghold are a Pan-African and Middle Eastern boutique investment bank, primarily looking at project finance for industrial or infrastructure projects. And more latterly, through the London office, we set up a trade finance team looking at the trade finance facets within said projects, and also standalone trade finance instruments for our ever-increasing client base. Very happy to be here and answer any questions that any of you may have.
Thank you. And moving to our other co-sponsor of the event, Contractor Gustavo.
Good morning, everyone. Very good to be here. Honored to sponsor this important event. My name is Gustavo Bergamasco. I'm the country manager for Contractor Construction UK. We are an EPC contractor based in London. We have origins in Brazil, and we have been developing infrastructure projects in Ghana for almost 10 years already. Projects such as airports, hospitals, roads, markets. This is only possible because we have a very good aid from our banking partners, and also the important support from UKEF and DIT on promoting business and allowing us to successfully export goods into our projects in Ghana. We are also looking into good opportunities across Africa, other countries. And I look very much forward to contributing to enrich the discussions on this panel, and I'll also be available to answer any of your questions if they arise. Thank you. Back to you, Steve.
Gustavo, thank you. And last but by no means least, Logie.
Thank you, Steve. Good morning, everybody. Logie Mackay, based in the UK, Managing Director of Shilton International. We're a global business development group with a stress on finance and funding companies, which I'll come to later, yeah? My own background is from studying in the dim and distant past, African politics, right through to be a shareholder in a company in Nigeria in the oil and gas industry. I'm honored to represent the UK Liberian Chamber of Commerce. I look forward to the discussion. I look forward to my participation, and I really look forward to answering any questions. Thank you.
Logie, thank you very much. So in terms of trade finance, Matt, trade finance can mean different things to different people. But can you define what trade finance means to you? And does it capture all the finance that companies should be looking to access in Africa?
Yeah, for sure. I mean, my definition really of trade finance is a financial bridge or the facilitation of a client's trade, which is usually from paying the supplier, either ex-works or a port, expensing the logistics, because obviously my boot collateral is the goods or the products that I've purchased on their behalf on their commercial terms. So I want safe passage, and then the collection and harnessing of the ultimate buyer's payment. So it's really just a financial facilitation of a client's negotiated and contracted trade. Obviously, there's a lot of moving parts. You have to check, such as the contracts each side and the financial covenant provided by the end buyer. But should all that check out fine, then that's an archetypical trade finance type transaction.
Great, thanks. Musa, the Bank of Africa provides considerable lines for trade finance in the various markets that they're present. For the benefit of our audience, can you outline in a little bit more detail what trade finance is and the type of products that you offer companies to lubricate the passage of trade?
Thank you very much. As Matthew already outlined, trade finance is basically the financing of trade flows, ensuring that it is done within an acceptable risk, both to the exporter and then to the importer. The aim of the exporter is to be assured that when they deliver the goods, payments will be made. And obviously the aim of the importer is to ensure that the goods that are going to be delivered will be delivered in the right quantity and the right quality and at the right price. Now, to do this, because of the risk element in it, there are certain products that we offer to our clients. And based on the sales and purchase agreement that Mark already mentioned, the right product or the appropriate product is preferred. For instance, you cannot skip any other product when it comes to letters of credit, for which Bank of Africa, we are very specialized in this area. We ensure that we issue letters of credit that are devoid of errors, that are devoid of amendments, and make sure that the client do not suffer so much, costs when it comes to amendment charges, because amendment charges usually comes with a lot of costs and sometimes may also result to dispute in terms of payment. So we offer letters of credit to our customers. Now, at Bank of Africa, we also ensure that our clients are able to leverage on some of the LCs that their import clients have issued to them by way of back-to-back LCs. We do also ensure or give opportunity to our suppliers credit clients who probably hitherto do not have so much trust between their suppliers, to also obtain standby LCs to secure their suppliers credit. Now, when it comes to another product that we at Bank of Africa offer to our clients is the issue about documentary collection. Now, documentary collections is not that secured as compared to LCs. And of course, to make it more acceptable to suppliers elsewhere, we offer what we call avalization to our import clients, such that it gives the exporter the comfort that they need in the process of the trade, which gives it some semblance of, of an LC, though it does not require much details. Of course, on the export side, to ensure that our exporters also have some sort of working capital to make sure that their operations continue without having to wait for documentary collection that has been sent out on acceptance basis, we do also discount, this avalized draft for them without recourse to the exporter. And this we are doing so well within the West African sub-region. We are sure that other clients within the UK corridor who present, such opportunities to us will be able to deliver on this mandate. Of course, we do also supply chain financing. So supply chain financing, where we look at we finance the receivables of the exporter and then also finance the importer to be able to import more to augment their stock. We also offer guarantees to our customers, both locally and then offshore. And so where our customer has a contract outside the country, and that's required, it does require that the guarantee be issued with by a local FI or financial institution. We are in position to issue character guarantees for them to be able to issue bid bonds, to be able to performance guarantees, and then advance payment guarantees in favor of our clients. That we have.
Sorry, go on. That's great, Musa. And interesting, you raised the points about bid bonds, which leads me perfectly on to the next question with Loggy, in terms of, Musa there is very detailed what is available in the trade finance, but of course there's structured finance and project finance. Could you perhaps dive a little bit deeper in terms of what structured finance is and when it's suitable for companies to consider?
Yeah,
and when
thank you, Steve. Thank you. Structured finance, really, from our point of view, I just make some salient points. It's really a financial instrument or a process when conventional or normal trade finance is not ready. Yeah, I'll also have to bring up a bias here. We usually talk, or our clients, our colleagues are usually smaller companies, I might add, and that's where it's very difficult to raise conventional financing. Yeah, so the salient points I would make, first of all, it's complex financing. Yeah, sometimes, if I use an example, zero emissions, the growth there in the oil and gas industry, sometimes there's a sort of, unique case there. Yeah, but everything that's done has to be done on a case-by-case basis. Everything's only as good as a business case, and the business case covers everything, very, very holistic. Yeah. Another main salient point is it accepts risk. Yeah. This is Musa was mentioning in the trade finance. I would say in structural finance, it's based that there's a high element of risk, and it's got to be mitigated. And that comes, how do we carry this out? How is the process carried out? And that can be rather complex. I've just been involved not in West Africa, but in the UK, and there was eight lenders with various demands, hybrid. It goes on, but luckily in our group we have a Swiss banker and also a Ghanaian banker who actually carries that out. One of the things that happens once you start this process, and I always find when you put a structural debt in place, it's very much, I wouldn't say a straitjacket, I would say it's very much the debt is very is not transferable. Yeah, it's once you've started the process, you have to carry it on, and it's not an easy ride, the thing, and I'll finally finish up about this and leave for the question, it comes down to expectation for people, especially in an SME. When you come out there, you have to expect people will do a deep dive on your company. When I mean a deep dive, they will cover everything, what you want to do. It all comes down to the business case. But I just finish up by saying it's good fun and there's a lot of money out there. Thank you.
Logie, thank you very much for that. Barbara, with International Finance Corporation, you guys have recognized that finance is trade for economic and social developments in the emerging markets. As mentioned in the intro, the pandemic has wrought havoc on companies' ability to trade. From IFC's perspective, what impact have you seen this has had on trade flows, and has it increased the barriers for companies to access finance in the last 18 months?
Okay, thanks, Steve, for the question. Certainly, in the last 18 months and occasioned by COVID, we have seen an impact on trade. But I have to say that the impact that we have seen are related to issues that previously existed, but what COVID has done is to, further exacerbate the issues that existed. Historically, trade finance has always lagged behind. Trade in sub-Saharan Africa. The gap was estimated at about $82 billion. Now, as we may well know, what trade finance does is to inject liquidity into operating cycles, and during crisis periods such as COVID, the variance between the supply and demand of such liquidity widened, and also as supply chains got disrupted, what it meant was that both buyers and sellers couldn't rely on interfirm credit. Now, we also reckoned that before the onset of COVID, there were corresponding banking challenges, as we saw a number of international commercial banks de-risk from sub-Saharan Africa due to a number of reasons, which includes regulatory requirements and the cost of compliance. COVID has not helped the situation at sea. And what we have found, and this is actually from a survey that was conducted by the IFC, and to which 86%, we had received 86% respondents from the banks that participated. 40% of them did actually say that, or they have actually experienced issues with their correspondent banking relationships, and these have largely been with restrictions to credit lines, increased cost of trade lines, and also higher margins on collateral requirements. So you'd see that all these have actually contributed to restricting the access to trade finance. I have to say, though, that the impact of this varies across geographies, but indeed in sub-Saharan Africa, the impact was immediate. But then government interventions, including policy reforms, moratoriums from regulators, as well as DFI support, have been critical in closing the trade gaps that were occasioned by the onset of COVID.
Great, thanks on that. And one of the things that we hear often at the moment is about the growing back greener and stronger. Could you give some views around that green the green support for trade finance?
So, well, indeed, one of IFC's commitments and focus areas has been to build back more resiliently and also build back greener. So you find that environmental and social governance issues have become quite embedded in most finance and structures. And this is an issue that I would say a development that most partner and prospective institutions must keep in mind and make sure that indeed these frameworks are built into their various activities, including underwriting. You find that in IFC, for instance, and within the last year, there was a commitment of about $4 billion towards green initiatives. And you don't see this with the IFC only. It does cut across a number of development finance institutions, which highlights the need to embed sustainability into activities, including underwriting and trade finance for most institutions. Now, the World Trade Organization, for instance, the World Trade Organization estimates that between 80 and 90% of trade is actually financed. And so it recognizes trade finance as a medium through which institutions it recognizes trade finance as a tool or an offering through which corporates and trading institutions and producers can be influenced to embed green finance into sustainability practices into their operations. And what IFC has done in this regard is to provide support services for partner institutions in building capacity, because we do recognize that it is a new phenomenon, and most institutions, including financial institutions and even the real sector, do have challenges with building up skill sets and also building up frameworks required for the embedding of sustainability practices into their activities. And so this I would say that is quite topical. It's quite relevant to institutions such as the IFC, and also becomes very relevant to trade finance activities.
Great, Barbara. Thank you for that. And so, Logie, Matt, Barbara's just emphasised the importance of sustainability and environmental social governance there. From your experience on working on transactions, can you highlight some of the key issues that companies need to consider when it comes to these points in accessing finance? Are there different levels of consideration between trade finance and structured finance? Matt, perhaps you could lead with the response on that.
Sure. Yeah, I think of late there's been a lot more impact reputationally, certainly on ESG, whether it be environmental, such as sustainability, where are products coming from, particularly in the timber industry. Is it rain deforestation, etc., etc. with regard to social, I think with anti-slavery and labour requirements, you know, there's certainly been a lot more onus from corporates on their own supply chains. You know, are they being corporately responsible? And there's a lot of reputational risk around all of these areas. And I don't know whether that's been led by the funders or it's been led by the borrowers stroke corporates, but there's certainly more of a spotlight on looking at all the facets of sustainability, supply chain, etc., where a product's coming from. And what you don't want to do is get caught out, as some banks have been, as some funders have been, with you know, a reputational impact on your business through, shall we say, not doing the right thing. So yeah, I think there's a lot more onus on this now, and a lot of banks and funders actually have ESG policies quite rightly in place to prevent anything like this sort of slipping through the net.
Thanks, Matt. And Loggy, from your perspective,
yeah, I think any comments I would make there would be, I think the first thing is, you know, look to yourself and say, you know, what projects you want to get involved in. And as a company, and as us as a small company, I mentioned it before, we work to the necessary legislation, not because we have to, it's because we want to. The Bribery Act and everything. And you really have to do a deep dive. If someone comes up to you with a project, you really have to do a deep dive. And that's not only on the you know, personnel in the project, for ourselves, because with the whole nature of structural finance, we draw money in from various places. The Middle East, it could come from Iran, the money, so we have to look at sanctions. We deal a lot with money that may come from Russia. There's sanctions there. So it's incumbent on us as a company, as a facilitator, to make sure we don't let down the project. And also, just to finish briefly, from also with people from projects, people have to be transparent. You have to, we don't want to deal with Gmails. We don't want to know who someone is. Come there, come up, open up. I can show you everything. And that's the demand, or else we don't move forward, you know, because we have to make a rather large business case also internally. And this costs us a lot of money, and it also costs the customer a lot of money. When it comes to the environmental, the environmental and green impacts, or call it what you want, we were engaged earlier this year in an environmental audit in the oil industry in South Sudan, a different place. But the situation is basically desperate there. But isn't a case you just throw up your hands. You work to sort of procedures, you work to milestones, and you work closely with your local partners. And, you know, luckily we're seeing a good result there. So, you know, what I would say, if you're entering into structured finance to find it for a project, you have to do a deep dive, and you have to cover, I'm sorry to use the old Americanism, you have to cover all bases. Thank you.
Okay, thanks for lessons. Andrew, we've started touching on areas around corporate governance. One area that banks look at very closely, the anti-bribery and corruption laws. In respect of corporate governance, how much importance is actually attached to this by banks when it comes to ABC issues, when looking at the viability and bankability of transactions? And what are the key elements that financiers are looking for to get comfort as to whether they should or should not support that transaction?
Yeah, sure. To say how important, I mean, it's just really hard to stress how high up the importance scale it is, the anti-bribery and anti-money laundering legislation that basically any bank that is engaged in trade finance or structured finance will go through. In terms of the product suite that we in particular offer, our deals, a lot of our risk is offloaded onto UKEF, effectively is the UK government. Our risk as a bank, it remains on certain issues, and one of those issues is KYC, anti-money laundering, anti-bribery, corruption. And so one of the key things that we do is we look at the corporate governance of any potential borrower. We are going through all levels of internet searches. We have background checks. We have databases that we have access to, and opening up and understanding who our borrowers are is effectively, once you are through the risk approval system of UKEF, the most likely thing that will cause you to not be able to get finance. It is a key obstacle. And so in order to ensure that that obstacle is not there for you, you need to be familiar with what banks are now looking for in terms of their anti-money laundering KYC packs, and that will include identifying all beneficial owners the whole way up the chain in clearly identifiable documents. I think my video stopped there. In clearly identifiable registered documents. It will be looking at the audited financial statements of the company and identifying that is it matches with the information we're being provided. It's identifying the key individuals in the business, getting their passports and their home information and checking them against our international databases. As I said, it isn't necessarily a long process, but it is absolutely a key process, and it is really a now necessary condition. There is no way around this. There is no hiding. We are going to keep going until we identify every single person that has significant influence in any business. And from the bank's perspective, the potential fallout for being wrong is so detrimental that they will pass on deals that seem lucrative. And it's really, really important to understand that even if you are offering a bank an opportunity to make a lot of money, they will pass if they consider that they cannot fully cross off that risk and stand in front of their regulator and say, we did every single piece of investigation. We identified every single potential avenue for bribery, corruption, anti-money laundering. We went through all those processes. We got to the very bottom of this business. And so that's why we're able to stand behind this deal. And they don't even need to have a problem. So they could lend to a business. That business could not be engaged in any of the things that I've just mentioned, but the regulator could say you didn't do your job sufficiently, even though that business is fine, and they could still get fines. So that's how important it is to the banks. They're not going to risk this. So be ready. If you're a borrower, be ready for those questions. Be ready to open who owns the businesses and who is influential in the businesses, so that we are able to cross off that hurdle and make sure that we are able to make those loans.
Andrew, thank you, and I think that message came through very clearly there. Musa, as a bank that's onboarding clients here in Ghana and elsewhere on the continent, could you give a sense, highlight of the areas where Bank of Africa often see companies overlooking when they approach you in terms of this corporate governance compliance space, and what are the key areas of friction or failure that you see?
Okay, thank you very much. Like Andrew mentioned, now when we are onboarding a client or a transaction is being onboarded, we take our time to look at the granular, parts of the transaction or the structure of the company. We make sure that in terms of the structure and ownership, it is quite clear, not ambiguous. We also make sure that your registration documents are up to date. We also make sure that you have other regulatory certifications up to date. So in terms of areas that companies usually overlook is the fact that they go to register with the Registrar General, get the certificate of incorporation and certificate of commencement of business, and feel that that is all. It depends upon the area that you are entering into. If you are entering into the mining sector, obviously you require further certification from the Mineral Commission. If you are entering into the pharmaceutical industry, you also require some kind of certification from the Pharmacy Council and so forth and so on. So what people usually overlook in establishing companies or carrying out their operations is not to go further to seek for permit from their own or their specialized areas regulatory institution, which often becomes a problem when we are doing a transaction for the person, because if you are going to import drugs of pharmacy, I mean, when I mean drugs, I do not mean the hard ones, drugs that are for medical purposes, and then we notice that you do not have the requisite certificate, sometimes it prolongs the transaction, because we would make sure that you go and get it done, you go and get it, renewed if it has expired. And all these are very important because it is for the good of the customer and it is for the good of the bank. Because if you overlook it and it turns out to be a matter of litigation, you realize that you lose your case ab initio because those documents were not, in order. And then as a bank, our reputation is also on the line. So we make sure that we get those things sorted out. So those are usually the key things. The other areas that are also usually overlooked is the fact that, okay, on annual basis, you need to submit your returns to the Registrar General, which people usually do not do. And if you have not done that, over the period, and you are caught up in a special exercise to be conducted by the Registrar General, if the timelines are very short to comply what you see, you find yourself wanting, which we always make sure that we get our customers, to be on top of these things. Our internal control and compliance departments are always, on top of this issue. So we bring it to the customer's attention before they get out of control.
Great, Musa, thank you for that. And clearly there's huge obligations on companies to ensure that they are up to date on all their various license and permits there. We've talked about some of the challenges. Let's just turn our attention for a moment to what good looks like. Gustavo, as the only non-financial institution on this panel, you are clearly on the user side of all of the panelists' products. Perhaps can you offer our audience some examples of what good looks like and what lessons you have learned through accessing both trade and structured finance?
All right, thank you. I appreciate we are the odd one standing out here today. So, but it has been a very interesting route that we took. We have been successful in using these tools that banks and ECAs offer to SMEs. And I know I took some notes here. So things that Logie and Matt and Andrew and Barbara have said. So it's a holistic approach, is managing the risk, adjusting expectations. It's all that. So in order for you to tick all the boxes, and you must tick all the boxes, there's some very, very hard work that you do prior to getting into any project. So at the end of the day, building is the easiest thing to do in our case, which we are SME. So we look and we say, okay, we're very anxious to get on and start building, because the initial process to be onboarded, to go through all the assessments on the project, doesn't matter if it's a technical one or if it's a financial one, if it's on the borrower side, if it's on the SME side. So it's a lengthy process, and you must be prepared to open up and be transparent, and it all comes down to choices. So I think success is having this holistical approach on the process. So it's choosing a good project, which will lead you to a legacy bigger than the project itself. It's thinking long term, so it's balancing both the local resources that you're going to use on the country, which is a foreign country, to the company where you're developing. So you must use local currency. You must bring in the culture to your projects. So they will work better at the end. But you also you have a commitment on the level of export goods from the UK, for example, which you must attend to. So it's this balancing with a long-term view, being transparent, and doing the deep dive, not only on with the company and how it performs, and ramping up its policies, being very, very strict about the ABC policies, training your employees. That's all. It's an holistic view, and at the end of the day, you have a sustainable process if you manage to do that. But just speaking is kind of easy, easier said than done, and it is a long process, and a very let's say exciting one as well, if you're willing to take the journey. So in our case, for example, we had an experience, smaller projects. We worked well on the smaller projects. We managed well documentation. We managed well this process to be onboarded, to work alongside the financial institutions. And and then when it came down to delivering the project itself, the process was kind of controlled and coordinated, that allowed us to jump to bigger projects and scale up the same structure, and tackle on bigger projects. And that process itself created the pipeline. So the success story of scaling up projects smaller to bigger, using the same, let's say, approach, helped to create the pipeline, because then the onboarding process became easier. Our internal process to control documentation that we need to provide to the stakeholders became easier as well. It's still a challenge, don't get me wrong. There's a lot of work there, but you kind of create the muscle to be able to do that, and you create the teams, and there's costs involved in it. And you have to turn those costs into investments, so you run smoother. So you think initially that you might take on a cost by creating a compliance department within the company, but actually that's an investment that will protect that project and your future projects, and it will allow you to do more business with the banking institution. So it becomes an investment for the company. So if you're working on governance, that's also an investment. So don't look at it from the perspective of cost. So, what I wanted to highlight is also that the banks and the financial institutions, they take a key role on the development. So as an SME, we are not familiar with all the hurdles and the path that you need to take. So you need to be guided by the financial institution, which operates in this environment better than the SME. So the SME's focus is on exporting, on building, on logistical issues. That's where the SMEs are concentrated. So all this process that you need to go through to be able to develop a project, that's the bank that needs to hold your hand and guide you through each step of the process, and lead you to make the correct decisions at the correct time that will allow you to push further. So we have been fortunate enough to work with good banking partners who were holding our hands and controlling you know, the basic stuff just as an onboarding process, which is basic for you guys, but also let's say a comprehensive conditions precedent list. So for a contract to come into force. So we were fortunate to have good banking partners that helped us on these steps. So the last thing I wanted to say about this, so uh, every project is a singular assessment. So you can replicate the process itself, but every project you do the deep dive, as Logie said, over and over again. So for every single project, we have to do all the necessary assessments all over again, and it takes time, and it's important. You do that deep dive, and I think so. There is no. I know it sounds cliche, but there's no right formula for success. You have to do a deep dive, have to be transparent. You have to assess every single project as if it was the first one. You have to adjust your expectations because these things take time and you need to be very straightforward and open. You have to rely on your banking partner. So not only choosing the right project, you choose your right banking partner because you know you're going to have all that support. And also, I think it goes without saying that we wouldn't be able to achieve this success if it wasn't for UKF support. So they did their homework, they did the assessments on us as a SME, setting up shop in the UK and willing to export to an African country. And they had the ability to understand that we were doing our best and looking to tick all the boxes. And in doing that, they provided ample support for us. So as long as you have an opportunity, they'll step in and help you out. So I hope it made sense, and I'm very happy to answer any of your questions.
Thanks, Gustavo. And just picking up one of the comments that you made there is, you know, you were on a journey from doing smaller projects to build up the trust, moving up to the larger projects that you execute today. And let me just turn to Andrew for a moment. You know, as a company that focuses on supporting the smaller deals using UK Export Finance supplier credit facilities, can you share examples of what good looks like on deals that you've done here in West Africa?
Sure. The comment I would make is what looks good in West Africa looks good everywhere, right? So it's the first thing to understand is right now you have a very willing partner in UKEF. I'm sure Gustavo will echo that. UKEF really launched this year proudly. AF Capital were the first user of what is called the SBLG, the Standard Buyer Loan Guarantee, which was relaunched this year. UKEF set up a division for smaller assets, which in export credit terms really means under £25 million. Sometimes people refer to it as under £50 million. But what we look at is everything really from £1 million upwards. For UK exporters looking to export their goods anywhere in the world, and a key demographic within that is West Africa. You have a very willing partner who recognizes that in the COVID and post-COVID world and in the post-Brexit world, the need for export credit support is important. Not the only method of exporting, but a method of exporting and a method of supporting the exporters. And so they're looking to help. So that's the first thing to put out there. But then what good looks like is a solid contract between a UK exporter and a buyer, whoever that buyer is. That buyer having an audit history. We would really look for 2 or 3 years, preferably 3 years of audited financial statements of that buyer, understanding their business, then being able to present their business in a very clear and understandable way. Being willing, open and honest in answering any questions that risk have. you are going to get questions about your business. It's just a fundamental part of borrowing is people are not going to just look at the numbers, put them in a black box and come back and say, oh yeah, that's fine or it's not fine. It's not going to happen that way. So the more willingness that you have to get on conference calls and explain your business and explain the numbers and the story behind the numbers, the more you're likely to get a willing credit committee and a willing risk committee. So what good looks like is openness. And then after that, really, it's all of the other things we talked about. It is KYC, it's anti-money laundering, it's clearly identifiable owners. And then I guess the newer issue or a new issue is the social and environmental impact. Every deal, according to a scale of the size of the transaction, has to go through some level of environmental study, an environmental impact study. I think last year, at the back end of 2020, UKEF said that they will not be supporting any hydrocarbon project. But more importantly than just well, we're not doing the oil and gas industry anymore, there is another element of, how does this project have a positive green impact? How is it more sustainable than it was prior to doing the project? They also don't want to be building on native lands or historic lands and those sorts of more social impacts. So it, understanding that there's going to be an environmental impact study and a social impact study done as well, and being willing to help and answer those questions, that's another element to it. And really, that's what good looks like. So well-presented financial statements, well-presented KYC anti-money laundering statements, willingness to answer questions, and willingness to do the environmental work that's needed to get a deal approved in today's market.
Right, and Andrew, and I think one of the most important takeaways from your comments there is that, here in Ghana, we're working to international standards because finance is an international industry and funds are fungible and can go wherever the deals suit their requirements. Just recognizing time, Gustavo, as you look into the next few years ahead, and the risks around the sting of the long tail of COVID. What are you looking from the financial institutions to introduce to support increasing trade or finance in the next couple of years? Very briefly.
Yeah, so we see that there's some level of challenges on the private reinsurance market. So we are mainly focused on having a project backed up by export credit agency. So this country cover limits, as long as UKEF, for example, keeps the support, and we'll always have that small amount that we would look into the private market. So I think that's one of the challenges. So risks have risen everywhere. So it's not this targeted to any specific market. And I think the other issue that we would heavily rely on banking partners is the providing us with guarantees, so APGs, performance bonds, that sort of thing to support our contracts with the buyers and the borrowers itself. So we usually have some sort of performance bonds or advanced payment guarantees attached to our contracts as part of our performance, let's say, package or insurance towards our main clients. So I think these two aspects are, for me, the most critical ones going forward. One aspect which is related to us, not to the institutions itself, is a good selection of projects. So as long as we keep our eye and our focus on selecting good projects, I think we'll be on the good side. And then with the aid of banking partners, I think it's a good team, a winning team.
Great. Well, I would say to that, any companies that can find a good deal, there's always a finance available to support a good transaction. Barbara, you've heard the comments today. the multilateral financial institutions play an important role, both in terms of thought leadership and interventions into the market. What are the current and future solutions that the MFIs are bringing in to support SMEs and allowing greater access to finance than they have previously been able to?
Okay, thanks, Steve. I think I'll start by giving a bit of context. So you recognize that SMEs are very, very important to economic growth and development. In fact, SMEs represent about 90% of businesses, and they account for about 80% of job creation in developing markets. So, I mean, this makes us realize how relevant this market segment is to economic development across sub-Saharan Africa. However, access to finance is a key constraint to SME growth and profitability. The data has it that more than 42% of SMEs do have constraints with access to finance, not to even mention access to long-term funding. And there's a huge gap, which is estimated at about 331 billion for MSMEs. And so it's a subject that you find that most development institutions are passionate about and seek to make interventions to assist MSMEs raise funding to promote their businesses. Now, you'd find that one of the key challenges that has contributed to lack of access for financing for SMEs is financial inclusion, which tends to be quite low in sub-Saharan African markets. And so financial inclusion has become a subject of global, I'd say, discussions and interest. And you find that even respective governments in sub-Saharan African markets have by themselves or are by themselves making interventions to promote financial inclusion, which obviously could also lead to access to credit for MSMEs. So you find that in some markets, there are all kinds of interventions which are geared towards increasing bank credits, risk mitigations, and also interest rates caps, ostensibly to reduce the cost of funding for MSMEs. But you find that the IFC and other multilateral development banks have a more holistic approach, I would say, to the issue. And so emphasis is not just on providing funding, but also to build, I'd say, to build blocks that would provide sustainable financing to MSMEs. And these include spurring reforms and policies, building up financial infrastructure to create an enabling environment for MSMEs to access sustainable finance. And we could use Ghana as a case in point, where the IFC and the World Bank have played critical role in building a more resilient and stable financial institution, and also helping with the financial infrastructure through interventions that have assisted the building of the collateral registry, the promulgation of the Lenders and Borrowers Act, credit bureaus, amongst many. I'm sure there's a long list, but these are some of the ways that IFC and other multilateral development banks seek to promote or prefer a more holistic approach to providing sustainable finance for MSMEs. Now, still on financial inclusion, we realize that there's a revolution in finance where in most cases there's the argument that in Africa, for instance, it has leapfrogged due to key enablers such as mobile finance, access to data, etc. And we also noticed that during the pandemic, the need for digital solutions were largely accelerated. And so the IFC has played very key roles in helping financial institutions build digital solutions, including strategy that can provide access, including last mile access to finance for MSMEs. Now, still on financial inclusion, IFC also has sought to promote lending to or financial inclusion for women as MSMEs, because the studies have it that indeed exposures to women have less default risks, and institutions such as the IFC seek to promote lending to women businesses. And in fact, in June 2021, IFC achieved a milestone of about 3.1 billion in promoting lending to women businesses. So that is on the subject of financial inclusion, which invariably helps MSMEs raise or access funding. Now, beyond this, IFC also provides funding. I think in the interest of time, we might not get into the details, but of course, there were, during the COVID period, we saw how IFC provided fast-track COVID response facilities. And also, in addition to these COVID response facilities, and to help financial institutions reach very small MSMEs, there was also the base of the pyramid approach, where IFC provided funding through financial institutions, not just banks, but microfinance institutions that have proximity to smaller businesses. And so these have been some of the interventions that the IFC has preferred. But in addition to that, we also have the Global Trade Finance Program. Of course, we've been talking about trade finance, so it is worth mentioning how the IFC has provided trade solutions to banks, which of course have been targeted at promoting and increasing access to trade finance during these difficult times. Now, when you speak to, and from some of the banks that we engage, they will tell you that liquidity was a challenge or has been a challenge in the last couple of months, but also one of the greatest challenges for these institutions are to do with uncertainties and risk perception in businesses. So you would find that some financial institutions have maintained adequate liquidity, of course, because you find that even during this period, loan to deposit ratios were lower, they maintained adequate liquidity. However, they called back on lending because of the perceived risk. And so another approach by the IFC was to motivate banks, and this is not new, but it's just, that during this period, it gives better incentives to motivate banks to lend more to the MSMEs through risk-sharing agreements. And what the risk-sharing agreement does is that the IFC, for instance, assumes let's say a 50%, it's usually a 50-50 bilateral agreement through which the IFC assumes 50% of the default risk. And through that credit risk mitigation tool, banks are then motivated to lend to MSMEs. Now, we also saw an uptick in our Global Trade Finance Program. And what that does is to guarantee the payment obligations for banks. I think, as we mentioned earlier on, banks had international banks had de-risked, and what it meant was that access to finance was more of a challenge. And what the Global Trade Finance Program does is, for instance, it's to guarantee the payment obligations of these institutions which then gives the international, banks comfort to establish trade lines and credits for the beneficiary institutions. So these are some of the means through which we have intervened in the market. And also there's blended concessional funding and first loss arrangements. Now it needs what that is supposed to do is to make funding or provide funding at competitive rates for our customers, but it needs to be mentioned that these concessional funding do not necessarily seek to crowd out private capital, but to set us, but rather as a catalyst to mobilize private capital. And so these tools are deployed only in situations or circumstances where the form or nature of the capital required is not available. So these have been some of the means through which the IFC and other multilateral development banks have intervened in making financing a lot more accessible to MSMEs.
Barbara, thank you for that. And what a wide range of interventions there from the likes of IFC and other DFIs in that space. In the interest of time, if I can just ask the panelists in a single word, what would be your advice to the audience today in accessing finance from the banks? Starting with Logie. You're on mute.
Sorry, Steve. Have a good business case. Have a decent teaser flyer. Go ahead.
Gustavo.
Yeah, approach the business with a holistic view. Look at the whole and think long term.
Great. Andrew.
One word, I'd go with openness. Openness.
Fantastic. Musa.
Clarity of financial needs and a good corporate governance.
Great. Matt.
I'd say clarity, to mirror what Andrew's saying, clear, concise proposal, offer up all the risks and mitigants. No one's going to tell the story better than the borrower, and the more time and effort they put in, the more that will reflect on having a decent assessment from the funder.
Great. And Barbara, last word from you in terms of advice to companies, a single word.
Single word?
Yes.
Okay. Maybe from where I'm coming from, you probably allow me a few phrases. So I'd say that sustainable finance is key. There's an increasing global commitment towards low carbon economy, and there's an increasing trend towards alignment with Paris Agreement. And so it is relevant to embed sustainability into all policy frameworks. Thank you.
Great, thank you. And it's now time for us to hear from the audience some questions. And just to encourage everybody listening in, please feel free to put your questions in the Q&A box. But starting with some that have been sent in just before this event. Musa, how far is Ghana in terms of online digital trading and cashless transactions? And I guess this also leans into the question from Robert about, is blockchain technology increasingly being used to verify the compliance, ethics, transparency of deals?
Okay, thank you very much. Digitization is very top on the government's agenda. And we are happy that government has taken it quite seriously. For instance, we have seen some kind of penetrations in terms of our digital, payment platforms. For instance, from a report we obtained from the central bank, indicated that mobile money payment had outstripped the use of checks by over 389 billion. So which tells you that people are gradually moving from the traditional way of using cash and then checks into, accepting the payments using, convenient platforms. You would also notice that where there is an opportunity, that is where company drift towards, and you would see a rise in the number of fintech companies trying to provide, mobile money, payment services, providing POS services at our various market centers and then shopping malls. So these are all manifestations that digital payments is gaining grounds in Ghana, even though we still have enough gap, to cover, given that recently we had some sort of attacks on our bullion vans, which is some sort of, a menace that is associated with, the use of cash. And so, though it is very acute for banks to move or for banks to move from cash-based transaction to digital transaction, there is an upbeat to make sure that we move from cash, based economy to cash-light economy, and that is what everybody is looking at.
Indeed on that. Loggy, there's a question here for you, in terms of how can I, as a startup business with great potential, access the funds available? And this is quite often a question that comes up about how do startups access finance?
Yeah, I mean, to come on, I mean, I was engaged with this question, Steve. Really, I'll say for my previous answer, put together a flyer and send it to me. Say in a 1 or a 2 page what exactly you want to do. Obviously, to back up for Andrew, Gustavo, and Matt said, have all the detail ready, but there's always a baby step. As Chairman Mao says, a journey starts with 1 step. And if you put that in a teaser and whatever, and we don't expect to see it slick or anything, bring it in and then we help, because I mean, one of the questions I would have answered about the greening or the projects we do, there's potable water, there's building ad hoc roads in Africa, and there's also autonomous power. Now, all of these technologies are ready now, and they're very transferable, and they're ready to build in Africa. And so I'm very optimistic. So to answer the gentleman or the ladies, I apologize, question is, please send me a teaser and we take it from there. And then we just put it around the group. It's as simple as that.
I'll come back to another question in a minute on the carbon side. But before I do, in terms of, there's a question here of an NGO that's seeking funding opportunities. Musa, any views about how NGOs access finance, given their particular business model? Musa, are you there? Looks like he's fallen off. Okay, we'll move on to the other question, and perhaps not only Loggy, but Matt, if you want to come in on this as well. How is the influence of carbon footprint, carbon credits being factored into any deal finance, or is it not a consideration at all? Matt, do you want to take that first?
Well, for me personally, I'm a bit rusty on the rocks and the double rocks. I haven't done anything in those spheres for a long time, but there were banks that were giving credits or double credits, and then obviously setting the amortization plane to accommodate those. Whether that ended up with a lot of sensible projects taking place is questionable. I think there were, going back about 5 years, a lot of projects that were more about getting the rocks than whether the project was particularly viable or not. Since it's gone to single rocks, I understand that yeah, either the funder or the client on the funder's behalf would make the application, and that any sort of credit or subsidy would then flow in as part of the loan product, and it would be re-amortized once that credit had hit.
Great. Okay, Loggy, on carbon credits.
Carbon credits, like Matt, I'm not the expert on that. You know, I really must admit that. I mean, all I can do is just mention to my tour de force about how there's so many environmental benign products ready for commercialization and implementation in Africa, and these are based on existing products and processes. But I would strike a note of caution. You know, I think it was Andrew mentioned about governments, especially in the West, have got a downer in hydrocarbons. In the rest of the world, such as India and China, they don't. We were asked to be involved in a project in Nigeria for clean cooking and clean fuel, which is a thing which is very personal to me, about, you know, taking away biomass and, you know, kerosene as a cooking method. And the only replacement I can see for that in Africa is to use LPG in cylinders. Yeah, but yeah. How do I, to follow up to Andrew, how do I tick the boxes to get funding from that? You know, so I just want to highlight there is challenges as well, and to follow up what Gustavo says, you really have to do deep dive to tick all the boxes. You have to see what the consequences of just what you want to do are, you know. And I would urge people, if they put in a teaser or a flyer, remember that, you know.
Great, thanks on that. Andrew, there's a question here about what is the definition of an SME? Often a hotly debated topic, but from the financial institution's perspective, what is an SME?
Yeah, I mean, we're not the people who determine it. It's really UKEF who determine that for us. But I forget the number. I think it's 50 million of revenue. Is that right, Stephen? Under UKEF guidelines. The UK government's guidelines talk about 50 million as an SME turnover, but that's for the UK. Perhaps I can also ask this question of Barbara. You know, what does IFC see as an SME in West Africa?
So yes, it might be quite similar to yours. So it's a combination of two, as long as the boxes can be checked for these two I'd say parameters. Employees of less than 300, revenue of less than 15 million euros, and $15 million, and total assets of $15 million. So once an SME checks any of these two boxes, then what can be described as an SME, or once a business checks any of these two boxes, that can be described as an SME.
Okay, thanks, Barbara. And Andrew, just sticking with you for a moment, another question here. A company's looking for information regarding financing options for more machinery to process raw materials in West Africa, but also expanding for normal working capital. If your views on that, and anybody else, if you want to chip in as well.
Sure. I mean, that blended position is difficult to access from a single institution. Normally, those two things are different programs. You are applying for different things, and I'm not sure that you would find a single institution outside of your home country that would be willing to do that. It may be wrong on that, but that would be my gut view, is that for your asset expansion, if you're buying from any country, but you know, we're here trying to support the UK, so let's focus on the UK. Applying through that exporter to the export credit agency if you're in a developing economy is a very, very good starting point. It's not the only starting point, but it's a very, very good starting point. You will find that if you are a credit-worthy borrower under the definitions of that export credit agency, you can borrow up to 85% of the contract value. That is a very large loan to value in today's market. And you will find that the export credit agency will talk to you about pre-delivery financing, effectively milestone financing, and post-delivery amortizing financing after the contract with the supplier has been concluded. So in terms of your access on that side, it's very good. The other side on working capital programs, it's not really my specialty, and I really would turn to another member of the panel who might be able to answer that much better, because we are not placed to help with working capital programs of buyers.
Okay.
Yeah.
Thanks. Yeah, unfortunately, Musa's offline, but we'll pick up the working capital question later. But given the time, we're just about running out of time. I know that there are a number of questions that remain unanswered here. We'll tell for the audience, we will take those questions away and get back to you separately with answers, and connect you with the people where there's a specific question to the panelists. But I hope you've all enjoyed today's session. Firstly, I'd like to thank the sponsors of today's event, Bank of Africa and Contractor Construction, without whose support today would not have been possible. But in addition to my panelists, who've shared their insights very openly and very succinctly, and thank you for your time. But a takeaway comment from me in terms of what's been said today: to access finance, it needs a very disciplined, transparent process, sharing information with your financial institutions, working with them as partners, not just on a transaction. Financial institutions are looking to develop relationships which benefit for the long term and ensure that there is a sustainable relationship. But as I say, any other questions, please feel free to reach out to the chamber, and we will coordinate the responses to those. Thank you very much, and let me just hand you over to Jennifer for the closing comments.
Okay, so then again, we want to say a big thank you to all our panelists again for having graced this occasion for us. A big thank you to our sponsors, Bank of Africa and Contractor UK Construction Limited. We're happy to have you all on. And if you have any questions for us, please follow our website and social media platforms, and also send an email to us, and we'll be happy to respond to all your inquiries. Thank you so much, and have a good day, everyone.
Thank you.
Thank you.
Thank you very much.